The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there are faring well and indeed surviving these tumultuous markets and these tumultuous times that we are experiencing right now. My name is Mark Longo from the OptionsInsider.com, as well as many of the programs on the Options Insider Radio Network, and I am joined, as always, by the yin to my yang, good old Don Schlesinger from the Volatility Exchange. Don, how are you doing this fine Friday afternoon?
Just great, Mark. Everything good. Another volatile week here, so we're on the right show with volatility.
Yeah, exactly. It's not exactly. It's a perfect week for us, exactly. All right, and with our introductions complete, we will roll right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the twists and turns of volatility over the past week, and there have indeed been a few twists and turns and ups and downs and spikes and troughs in the world of volatility. And to kick things off, we're going to turn to our volatility pit reporter, good old Mark Sebastian from OptionPit.com. Mr. Seabass, what have you been watching in your volatility review for the past week?
Interestingly, I thought yesterday, which is Thursday, the magnitude of the movement in implied volatility was the greatest we've seen. And I'll explain why. You know, we only dropped about 50 handles on the S&P, which, by the way, the fact that I said we only dropped 50 handles showed you how crazy it is.
Yeah, that shows our frame of reference now has completely changed.
But interestingly, the VIX at points was up, 13%. And when I say 13%, I mean 13 points. But remember, the VIX is a percent. So in magnitude of vol to move, yesterday was I actually measured it bigger than even the one from Monday. And actually, Monday, some of that vol was a little fake because it all came in the last minute and a half.
Yeah, we had a big surge at the end there.
Yeah. So if you look at just general fear, I thought last week or Thursday was the biggest day of unbridled fear that we've seen. One wonders how much longer is this going to go on? Well, it's until Europe figures their stuff out. So that's kind of the story.
We debated quite a bit on the option block yesterday, and your steadfast replacement there, Andrew, did a valiant effort at also trying to speculate on why on earth we were down 50-odd handles in the S&P and 400-plus points in the Dow based on the news of yesterday and the events, and no one could really wrap their heads around a precise reason for it, let alone the VIX up another third. But we kind of just came down to the conclusion that this is the new frame of reference that we're in, and these sorts of dramatic swings are simply par for the course for at least the next few sessions until we start steadying off maybe, and your downside VIX comes back into play.
Okay. Yeah, I'll be real interested. So, that was my weekend review was, we exploded on Thursday. Now we're sitting here just kind of hanging out, tell you the truth. Not shocked. The interesting thing about Thursday was vol exploded, but at the same time, we didn't have this end-of-day rush to just sell. It was a really weird day.
No, we actually had a little bit of a end-of-day rally few handles or so. Well, compared to previous 400-point days when the end of the day it closed down another 10 handles in the S&P, it seemed to be a sign of maybe some light at the end of the tunnel.
Yeah, no, I'm interested. I think we've got another shot at. You and I were both talking that we thought that there was a big pop somewhere left. Maybe yesterday was it. That'd be wonderful.
I could easily see us continuing on this road for a little while though, and shooting down to the downside again.
I'd like to see us break. I'd like to see us get up to 1250. That's what I'd like to see. No, I think we've got another. I think we may see 50. To tell you the truth.
Yeah, given these spikes, I wouldn't be surprised to see more upside in VIX before we see downside. And so yeah, we'll test those flash crash ranges, and then maybe we'll settle back off to the mid 30s or so.
I would comment to people that these are the times where where smart traders that have been at the side can take advantage. So do so.
All right, and thank you for that, Mark. And of course, we cover the broad spectrum of volatility products here, including the crazy world of Euro and the Euro vol contract, which tends to move quite a bit these days. So, Don, give us an update on what kind of movement we've been seeing out there in Euroland.
Well, interestingly enough, after some quite volatile times, actually seeing for the front month September 1 month realized volatility, a bit of a calming down, if you will. We're 9 days into the 24-day realized volatility calculation period, and those 9 days logged and in the books already have produced 9.9 realized volatility, so considerably lower than what recent history for the previous contracts has been. Despite that fact, the contract itself settled at 1150 last night, indicating that for the portion of days remaining, the 2 weeks or so before the contract expires, traders are still forecasting considerably higher, about 12.4 volatility that would justify trading the contract at 11.5 right now. Meanwhile, the 3-month September is 54 days into its 69-day calculation period, and we've logged 11.8 on the partial realized volatility with about 15 days to go. That contract is also trading higher, settling at 12 last night. So traders again are implying that the portion to go, namely those last 15 days, might show as much as 12.5 to about 12.7 volatility. Usually we stop here and talk just about the euro, but I'd like to take just another minute to actually go to the equity markets and the S&P 500.
Why, has something been happening out there that I'm not aware of?
No, nothing untoward, but we constantly see and read articles about what's happening with VIX and the fear gauge and what have you. I just take a quick different tack and look back historically at what has happened over this past month or so, and we're looking at the E-mini futures on the S&P 500 and looking at 1 month historical volatility, backward-looking realized volatility, and that's checking in at 45.6, which is quite remarkable for an entire month. Obviously, shorter dated periods can show higher volatility than longer dated ones, but to go a whole month with 45.6 volatility is quite unusual. When
that's serious volatility.
Monthly average can be anywhere from 14 to 18 or so. And even more extraordinary data, the listeners have heard us discuss volatility of volatility for some time, and we've talked about how in the equity markets, particularly for the shorter dated 1 month contracts, you can get vol of vol in excess of 100%. Well, this past month, as of last night's close, the volatility of S&P volatility is 189. So these are quite extraordinary numbers. And when you see the 3-month vol of vol at 112, then you know that crazy things are happening. So
yes, we're seeing the broad indices like the VIX swinging a third a day. I mean, so we're seeing pure, true volatility of volatility these days. It definitely is a good time to be a volatility trader, or perhaps a savvy volatility trader. Let me amend that, because we see a lot of people diving in and being degenerate premium sellers, as I like to call them, and just hitting bids on some of these every option they see. And those people tend to have been shaken out in these types of environments, including, I'd imagine, a lot of retail who tend to favor selling downside puts in these weekly options. And I'm sure a lot of them have had a significant comeuppance over the past few weeks, let's say.
yeah, I'm sure that's true. As we speak right now, it's Friday afternoon, 12 noon Central Time. The S&P is quite flat on the day, not even down 2 points, and Dow down 45. So I don't have VIX up in front of me at the moment, but I expect that with the somewhat calmer day and the weekend coming up, we'll probably see a drop in the implied volatility index.
Yes, with the weekend coming out and the fact that we're not moving 50 handles in the S&P and 400 plus handles in the Dow, the VIX, this is a nothing day. This is the VIX cash is currently at 41.30, down about 3% to 1.5 points. So that's where we are right now, listeners, and we have a guest who is chomping at the bit to get on the show. So with that, we're going to close out the old volatility review and roll right into our volatility viewpoint section.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint segment. This is, of course, the portion of the show where Don and I bring on an interesting guest from the world of options and options trading, and we pick their brain. And today's guest/victim is Euan Sinclair. He is the author of several options tomes, including Option Trading and the more recent Volatility Trading. And of course, he also works over at Bluefin Trading as their risk manager. Euan, welcome to the program.
Thanks very much for having me.
And now, Euan, since this is your first appearance on the program as well as on the Options Insider Radio Network, why don't we start things off with you giving our listeners a brief overview of your history in the options and derivatives business and how you got to be running the risk over at Bluefin, as well as writing some tomes on the subject.
Sure. Well, the first I'd ever heard of derivatives was actually back when Nick Leeson was blowing up Barings Bank. And at the time, I was kind of realized that a life as a physics professor probably wasn't going to be in my future. And so I started looking around and was hearing about these rocket scientists who were needed for option trading firms. Then I worked as a market maker for 3 or 4 years on the DAX and the Eurostoxx, and then gradually moved into sort of more of a quantitative risk role as more of a generalist. And I've sort of been doing that ever since at companies that have often been the same people but have gone by different names and is now called Bluefin.
Yeah, we see that quite a bit in the derivative space, where the same people, same faces, different business cards for the firms. But it's ironic, you had the same catalyst, the same flashpoint for derivatives that I did. I also was lured to the dark side by the Nick Leeson Barings fiasco. At the time, I was contemplating becoming an engineer, and then I was lured to the dark world of derivatives and have not left since.
Well, I think also back then, which I'm guessing for you was early to mid 90s as well. I mean, there weren't really all these masters in financial engineering courses. So firms, if they wanted someone quantitative, had to really go to engineering schools or physics schools.
Yes, it was unusual. I was fortunate that I attended a school where they actually had some coursework you could take on derivatives, and some of it was also in the graduate business school, which I took as an undergrad. But so I had a little bit of an introduction before I came out to Chicago and dove into the pits. But yeah, most kids, especially these days, I'd imagine, are having a difficult time finding that unless they go to a very specific school with a very specific curriculum.
Well, right. The industry needs different people now, and also far fewer people. It used to be that if you were a stock option trader, you'd trade maybe 2 or 3 products, whereas now we have traders who are trading several hundred products. Everything's more automated now. You don't need to be physically standing in pits. It's just The senior people, the experienced people, there are still roles for them, but we don't hire, 10 new people every year just to throw them in a pit.
Yeah, the physical need for presence is greatly diminished in this online world. Well, Euan, you obviously mentioned in your introduction that you've written several weighty tomes on the worlds of options and derivatives trading, and the more recent one, Volatility Trading, which of course fits very well into our purview on this program. So why don't you tell our listeners a little bit about what you wrote about in Volatility Trading and what the kind of core premise of the book is?
Right. Volatility Trading was meant to be my attempt at a sort of a dynamic hedging by Taleb level book for someone who might have been a trader for a couple of years. And by trader, I mean someone who's semi-professional at least, someone who understands the basic concept of hedging options to turn them into a non-directional bet. Now, as you know, market makers don't typically derive most of their money through their position, but they're inevitably left with a position. And this was designed to give them the optimal ways of hedging that and trading that so they could make money from market making and then hopefully keep more of it. So it focuses a lot on hedging techniques. Whereas dynamic hedging, which was, as I said, my inspiration, doesn't really spend an awful lot of time talking about when you should hedge, how you should hedge. Should you hedge at the end of every day? Should you hedge when the stock moves a certain amount? And so forth. I mean, it was called dynamic hedging, but it's not really, doesn't really get into the specifics of it.
That's interesting you would choose to write a book about that, because that's a subject we have discussed at length on this program, and we've outlined numerous times why that is one of the clear hallmarks, the clear separators or delineators between the basic retail and then the more advanced traders and the professionals, because your basic retail is typically coming in and putting on a directional play in the options, whereas the professionals are much more focused on the volatility and they're trading typically delta neutral, and they're doing things, like you said, like using dynamic hedging to offset their bets. And quite frankly, it's why it's so difficult for a retail trader to come in who isn't familiar with concepts like delta neutral hedging and gamma scalping, and for them to trade long premium effectively, because they don't have those tools in their arsenal. So you're saying they could pick up a book like yours and it would help equip them for that type of trading?
Yeah, I think it would, and it would also probably give them an idea why it would be difficult for them to compete directly with the pros. I think a misconception people have with trading is that the pros are in some way better. Like if you think of sports, for example, if you're playing golf, the reason you're not a pro is you're not as good as the pros, but you're playing exactly the same game. Whereas professional traders tend to be playing a very different game to amateurs. I mean, like you say, amateurs or semi-pros or whatever you'd like to call them, and I don't want to be derogatory, they typically put on options trades as directional bets with certain non-linearities to them, like they want to put on a spread or they want to put on a risk reversal or something. But it's a directional thing largely. It's answering a question like, if this stock goes to 105, which I think it will, how do I make the most money with the least risk? Pros just don't think like that at all, as you know. And even if an amateur can't trade like that, because the costs can be quite prohibitive, then at least they'll understand why they're having so much difficulty sometimes when the pros tend to make money far more consistently.
And of course, Euan, the fun part of this and what you've just said is our listeners know that I just completed some options conferences. I do summertime training at Morgan Stanley for their analysts and their associate programs. And we get to the part of the presentations when we talk about directional trading against delta neutral hedging and capturing of volatility through options straddles and therefore attempts at non-directional trading. It's always very fascinating to them. Most of them haven't been exposed to anything like this, particularly in undergraduate courses. When you talk about the follow-ups and how to get delta neutral and when you might do that, the first question on everybody's mind is, so what's the rule? Exactly when should I do it? And I kind of jokingly say, that's really not something that you go and look up in a book. Well, maybe times are changing and maybe there's a book where they can look this up now.
Yeah, you should have brought Euan's book with you when you gave those classes.
Next year.
Seriously, next time you're talking to a big class at Morgan Stanley, please bring my book.
There you go. We'll
I
hold
don't
it up
think
next
it's fair
year.
to say that there's no art involved in hedging anymore, because I do think that that is an element where a good trader can add money. However, I do think most traders massively overrate their ability to do that.
Yeah, we joked on our previous episode last week that that gamma scalping and hedging like that is a very black art, and that even when you're doing it well, you're still upset because you're usually missing a few ticks here or there, and there's always a way you could maximize your gamma scalping to be more effective. So I think most options traders who employ this technique are typically upset at themselves over it, even though they think they are very good at it.
Well, the other thing is, as I mentioned earlier, if you're trading 200 stocks, I mean, with the best will in the world and the best ability in the world, you can't follow them all to the point where you can maximize your P&L by picking bottoms and tops. At that point, you have to automate things.
Yes, exactly. Especially now when people are, like you said, are trading vast books with hundreds of stocks. They're not sitting in one pit with a handful of names. They need to change the way they handle those hedging. And speaking of hedging, one of the reasons we wanted to have you on the show today is an interesting topic that with this recent paper you wrote called Volatility Estimation via First Exit Times. And in this paper, you mention an interesting method for tracking volatility. Now, most people, or measuring volatility, most people tend to refer to volatility and measure their volatility using the standard close-to-close method, where they essentially just measure the swings between the close. And what you put forward in this paper is actually an alternate method, which I think is very interesting and would be very compelling for our audience, which is called the barrier method, or the first exit time method, I suppose you can call it. So why don't you, instead of having me summarize the paper, why don't you give a synopsis of the paper for our audience and what your main point is of the benefits of this first exit time method of measurement versus the traditional close to close method of measurement.
Right. I mean, I'd first like to point out that most of the actual work in this was done by a friend of mine called Chris Merrill, who we've had a lot of conversations with over the years. Well, I have. And I certainly helped a little bit and did the write-up. The basic idea is that when we talk about volatility in a financial situation, we don't really mean standard deviation of returns. That's how it's defined mathematically, but that's not really what we care about. What we really care about is how much is this thing moving around? And then the stuff we do after that is really designed to put that question in a way that can be answered mathematically. So the standard way, as you say, is to answer that question by looking at the standard deviation of daily returns. And that kind of phrases the question, how much is this thing moving? Another way is to say, well, let's set two different levels in the underlying. So say it starts off trading at 100. Let's put a barrier at 99 and another one at 101. And then we ask the question, how quickly does it bounce around within that barrier? Because another way of looking at volatility isn't how much something moves, it's how fast something moves. And that sort of comes back to whenever you see volatility in finance, particularly whenever you see variance in finance, you'll see it accompanied by a multiplier of time. Because volatility and time are basically the same thing. If there's no time, volatility doesn't matter because it hasn't got any time to act. So this is another way of looking at it from an engineering perspective would be to say we normally operate in the time domain, and this is looking at analysis in the frequency domain.
Yes, I think that's a very interesting point. And you think, because quite frankly, the traditional methods we all use to estimate or measure volatility don't take that time component into consideration. And you're right, that is what most traders are actually focusing on. They want to know not just how much the underlying moves, but how quickly it moves, it gets to that point. I mean, look at the recent swings we've been seeing in recent days. To give an example of rapid movements, we have things like the VIX gapping up 30% in a day. That's definitely a rapid movement, a high vol, if you will. Now, I know one of the before we even get into some of the benefits of this method, Don and I were having a little bit of a debate before the show, and maybe you can answer this for us. I came away from your paper with the opinion that you are talking about actually a different inherent number than the close-to-close volatility measurement method would generate. And Don had the opinion that you might be talking about a similar or a different way to get to a similar number of the close-to-close method. So which one is correct there? Are you actually talking about a different entire number for volatility, or are you talking about maybe a more accurate way to measure that close-to-close number?
I think I'll have to side with Don's interpretation. I mean, I would say that this is different in the same way that the Parkinson estimator is different from the close-to-close estimator.
Yeah.
I mean, Parkinson looks at ranges, and we are looking at the speed it takes to traverse a range. But both Parkinson and close to close, the first thing they do is they set a time interval, and then they look at either random returns within those time intervals or random ranges within the time intervals. Here we fix a range and look at random times to traverse the range. But hopefully we should all arrive at the same number in the end.
Yeah, it was interesting. I had kind of mentioned and invoked Parkinson's and high-low and intraday methodology. What's kind of interesting about this, and sometimes seems counterintuitive when people first come across it, is that we talk about the fact that close to close often will miss some intraday volatility. Obviously, if you're up 100 points at noon and then down to the close and you say, oh, well, we were unchanged on the day, doesn't really tell the whole story of what took place during the day. But separate from that notion is the idea that you can use intraday movement not to invoke a different metric and to come up with a different volatility, but to come up with a more efficient and faster way to arrive at that seemingly, contradictory close-to-close volatility. So I took away from reading your notes, which were fascinating, that this barrier type of concept where you set intervals up and down and then see how quickly you touch them or take them out was just going to allow you to invoke this intraday movement to come up with a faster and more efficient way of measuring that standard volatility that we all quote, because most standard deviation calculations, as you obviously know, usually require about 20 data points before you can even say you have any validity for a standard deviation calculation. And, waiting 20 days to be able to talk about the volatility of any underlying asset seems a little bit onerous. So if you've come up with a way to make that quicker and more efficient, then obviously that's quite useful.
And this also has the added benefit of when the markets are moving more quickly, this will converge more quickly to the true solution because it means you'll be traversing your ranges more quickly. Whereas the standard close to close, if the markets are moving around a lot, you're still waiting for the same time to make your observation. So you don't really benefit at all in your precision of observation in volatile markets with close to close, whereas with the range-based method you do. So it makes it good for online estimation.
Another question, Euan, I don't remember all the details of my first reading of the paper, but I imagine that arriving at what these barriers are in terms of absolute distance from the current levels, in other words, the width of the interval, was somewhat of a trial and error methodology to try to pinpoint what would be the most effective way to do it for you. But then I also obviously wonder if it is related to the historical volatility of the asset to begin with, such that lower volatilities may permit for tighter bands, while higher ones might warrant slightly wider bands before you say you've taken out a particular barrier. So could you talk a little bit about that methodology and whether what I've just said is true and how you actually did arrive at what you would consider the optimal trigger points?
That's a good question. I'm not sure there are technically optimal widths for these bands, in the same way that I'm not really sure that there are optimal observation periods for close-to-close volatility. I think that is sort of an arbitrary choice you make at the start. Now, as you say, if you've got a very low volatility instrument, you'd want narrower bands. Otherwise, there's a good chance you'd never make an observation at all. And if you've got a more volatile instrument, you might want wider bands because you don't really want to be calculating this at a point where really what you're dealing with is just bounce between the bid or the offer, for example.
Right, a lot of noise.
Right. So I think that is something of that's sort of where you could say that art still comes into it.
So we're getting back to the same problem with the gamma scalping that we discussed earlier, where there still is a subjective art/feel component to it, where you have to choose the proper barrier, the proper limit for your underlying before you can even really accurately apply this methodology.
Yeah, I think that's true, and we can look further to see if we can do slightly better than just throw our hands up. I mean, for example, there have been papers on the close-to-close methodology for determining optimum sample time if you know about the characteristics of the bid-ask bounce. I mean, that's one of the reasons people doing high-frequency estimations normally don't go lower than a 5-minute sampling period, because at that point you're really just measuring noise. So there's probably something we can do along those lines if we incorporate the bid and the offer into our analysis, but we haven't done it yet.
Yeah, it just kind of seems to me, and obviously you're intimately involved with the research, and I'm kind of observing or coming in here, but I guess it seems to me that the methodology obviously is quite fascinating, and that in the end, what you're really trying to accomplish is to come up with a more efficient manner for arriving at a volatility calculation than again waiting for these close to close. And it's just a question of trying to get these bands to be wide enough so that noise and static and information that really isn't all that important or really doesn't contribute to an accurate volatility reading will be incorporated, but not to make it so wide as to miss the opportunity to make it narrower and therefore make the efficiency of the method, all the better. So whatever it would take to define mathematically what optimal is in terms of getting the reading and the convergence that you're looking for and doing it in the most efficient manner, I guess maybe that's something for future or ongoing research.
Yeah, I think so. I think now that you've brought it up, I think we could look at that some more, and I think it would be useful. One of the things I like about this is that it does give you faster convergence in markets that have become more volatile, using the word in a non-technical sense. But it also kind of corresponds to how traders think about volatility, and it sort of answers more the questions they want to know about volatility. Like, if I put my hedges at these levels, how many times can I expect to get hit? It sort of corresponds more to what traders think of when they're thinking about volatility and gamma hedging.
I like that you refer to them as bands, Don, because that'll probably be an easy way for us to explain it to our listeners who haven't read the paper. It's analogous to a Bollinger Band type theory, but for volatility.
And, in the options world, we have what are referred to as barrier options, and sometimes they're just one barrier, but sometimes they are two-touch and what are called double barrier options. And it involves when the underlying either touches a level above or below a certain strike, something happens. Either the option gets its life, sort of like kicks in, or else it dies on the spot and, loses its value or whatever. So you think of those as kind of bandwidths around the particular current levels at which something happens. So it's a good way of visualizing what's going on.
Now, Euan, one of the reasons we brought up this paper is it ties very, very neatly into what we were discussing earlier, which is, of course, the gamma scalping and the many nuances of delta neutral trading and the difficulties of maintaining that delta neutral hedge on an ongoing basis. And one of the benefits you cite in this paper is that you feel this first time exit barrier method will actually improve your delta neutral hedging because you'll have fewer irrelevant, I suppose you can say, hedges, or fewer hedges in general to reduce your overall costs and the difficulty of managing those types of positions.
Well, I hope so. I mean, I tend to think you should have, when you're estimating volatility, a couple of different estimates that ideally use different data or use it in a different way. So, for example, I still use close-to-close volatility. I use close-to-close sample every 15 minutes. I think that's useful. I've had a lot of experience with it. We understand its biases and its inefficiencies. And when I mean understand, I mean you can actually correct for those statistically. I also use, high-low close estimators. I think they're useful. And when they're notably different from close to close, I mean, that's telling you something. It's telling you that where close to close is saying it's 20% vol and the high-low close is saying it's 30, obviously you're moving more during the day, relatively speaking, than you are close to close. And that may want to impact your hedging decisions. And I think this new estimator, it's another tool. If this is telling you that things are really volatile, well, obviously you're moving very quickly. So maybe you want to start scalping more aggressively. I mean, I would never say there's a perfect volatility estimator in the same way there's no such thing as a perfect car. You know, what kind of car you buy depends on a lot of factors. If you've got 7 kids, you're going to want something different than if you don't. You have to look at the purpose you're using the instrument for.
Yeah, and of course, you bring up something interesting on the high-low being 30 and the close-to-close being 20. Not only might that have implications for follow-up trades, but obviously for the kind of trading that you're doing, namely if you're a buyer or a seller of straddles or of volatility or of time premium, because in the instance that you cited, if high to low tends to be 30 but close to close 20, then if I'm long these straddles and so-called long volatility, I may want to jump on something intraday because it just may not be there by the end of the day, and I have foregone an obvious opportunity. Whereas when you're on the short side, you really want these follow-ups to be few and far between, and you want to learn the ability to sit on your hands, if at all possible, to not be pulling the trigger too frequently and locking in losses. So if the data tells me that high-low is 30, but if I just sit a little bit, it might be 20 by the end of the day, then the same information can be used in 2 very different ways for 2 different types of trading approaches.
Right, and I think it's important to emphasize there, I mean, you've done this implicitly, but it's important to emphasize just because something's been that way when you've measured it in the past, you have to have a reasonably good reason for thinking that that's going to continue. Now, in some situations, it's easy to identify that reason. For example, if you're trading ADRs, then an ADR is going to have most of its movement overnight because most of its news relating to the stock has come in the foreign market. So you could reasonably expect, in that case, close-to-close volatility be much higher than intraday volatility, and you could base your decisions on that. But if it's just happened for a stock and you don't really know why, that's when you have to be a little bit cautious, because sometimes what you've measured in the past is just a historical artifact, and it doesn't mean it will persist going forward. And again, that's part of the art of trading.
Yeah, I would surely agree with that. In this case, then, in speaking about that, this is surely a good deal of science, but still a great deal of art and feel that's still related. I'm curious in your own approach, which of course I'm sure is multifaceted, but as you're doing your trading and your risk management at Bluefin, have you invoked a lot of computerized algorithms and ability to watch multiple markets simultaneously, so that a lot of this is actually programmed into automatic trading, or is there still a lot of watching the pot so it doesn't boil over and still some personal decisions to be made along the way?
Oh, wow. Yeah, all of the above, I think. Most of our individual traders statistically trained in these things that we've been talking about, and that how volatility is measured and what it means. But their actual trading involves quite a lot of discretion as well, because we like our traders to be able to identify not just what has happened in the past, but why they think that will continue or why they think it won't. So it is a multi-level process there, and I would liken it to baseball, for example. If Albert Pujols goes 5 for 5 last night, he batted 1,000. That's an indisputable fact, and that's what the statistics will say. But it doesn't mean that he's a 1,000 hitter and is going to bat, 20 for 20 in the next 4 games. So you have to be very careful to distinguish between what you've measured and whether you think it's going to be persistent. And I think at this level, that's something that our traders can do better than a computer can. And then I would say on the risk management side, I actually tend not to lean on statistics at all very much, because if I do, I will find myself almost always agreeing with the trades the traders have on, because they would have put them on as a result of the same statistics I'd be looking at. So for risk management, I'm not really interested in the idea of whether this trade I think will be profitable or whether it will lose money. It's more like looking at worst case scenarios, like looking outside at a meta level. Can this trade blow up the trader? Can it blow up the firm? And that's something I think you can definitely do extreme value statistics there, which the traders wouldn't be looking at. But if I just look at the standard deviation of the stock over the last 60 days or whatever, I'm going to come to the same conclusion as the trader, and I'm going to end up agreeing with everything they ever do.
Well, it's a very interesting outlook, and I agree with you. An analogy popped into my mind that listeners might find a little bit strange, but I'll explain myself. I do a great deal of proofreading. I happen to be kind of a fan of the English language and style and grammar and editing. May be funny for somebody who sounds math-oriented, left brain, right brain, but I just happen to enjoy doing proofreading. And when you do proofreading, it's a very, very different mindset from somebody who's reading a book or a novel or what have you for the simple enjoyment of it and for enjoying the elegance or the art of the style or what have you, where you want to just lose yourself. When you do proofreading, you have to look at every single comma, every period, every phrase, and you have to challenge it. You have to dare it to be right. It's almost like saying, I dare this to be correct. I'm going to find a mistake here. And it just struck me when you just said that, because instead of admiring the traders' positions and saying they're all very smart people and they must know what they're doing, so everything is wonderful here, you've got to look at every one of these positions and say, something could go wrong here. There's got to be something wrong with this. What can I find that could blow up the firm or whatever? And I dare you to be, acceptable to me. It may seem funny that I make the analogy, but that's what struck me as you were speaking.
Yeah, the role of the risk manager is definitely to take a bit of a longer and perhaps a more macro view than the individual trader. And he's there to put on individual positions that are going to maximize his P&L. And your view as the risk manager is a far different game and a far different beast than what the trader is looking at. We discussed this paper at length, and I'm sure it intrigued quite a few of our listeners, and they may be interested in applying some of these techniques to their own individual trading. Is there anywhere this paper is available for them, or maybe alternately, are there some platforms out there right now or modules that people can plug into their existing systems that will incorporate this methodology? Do they have to pretty much go out and hand code it themselves from scratch?
I'm not aware of anyone that's implemented this. This was published in a 1988 paper by Cho and Fries, which would be available. The thing is, I've never heard of this, and I kind of like to think I keep up with volatility estimation methods. And as far as I can tell, Christopher Merrill, my co-author, completely reinvented this, and he wasn't aware of this earlier work either. So I think this is sort of one of those things that could have been discovered 25 years ago and was, but then just got forgotten. So I think at this point, it's not available. The Cho and Fries paper is available. SSRN, Social Science Research Network, would have it on their website somewhere.
Yeah, I was surprised to see that 1988 footnote citation there in the paper, because you're right, I was not aware of anything like this. I mean, obviously there's the analogy to the Bollinger Bands and the broad spectrum, but I've never seen anyone really targeted down and drill down this type of methodology specifically for volatility and volatility hedging and volatility measurement.
Yeah, I was amazed first when Chris showed me you could do this, and then I was even more amazed that someone had done it and no one else had ever pointed this out to me. I mean, it's like I said, it's not only was I not aware of it, Chris, who's a very smart guy, wasn't aware of it, and no one I've asked has been aware of it either. To your other point, we are hoping to publish this little note somewhere, but we've still got a little bit more work to do on it. I hope it'll be out somewhere by the end of the year.
Well, our listeners will have to stay tuned to the show, and we'll keep in touch with you when you have more updates. And when the paper is available and published, we'll have to let our listeners know so they can go out and find it for themselves and try to implement this on their own and see if they can get a feel for what the right barrier is in their different products, and if this does indeed improve their delta neutral hedging and their other aspects of their trading to really make them more profitable in the long run. And that's pretty much all we have for this segment. But before we go, is there anything else you'd like to mention to our audience? Any other upcoming books or articles you have that you might want to recommend to them, or anything we neglected to cover today that you feel like you want to address?
My current research project, and it's really started about a month ago, to sort of go back to basics and stop thinking of the volatility of a stock as purely a mathematical thing that I can measure, and start looking at volatility classified by different types of underlying. Like, for example, if you're looking at a football player and trying to project how they'll age, you wouldn't look at an offensive lineman and use the same methodology as you would for a running back. Running backs only last 2 or 3 years. Offensive linemen can last for 10. But when we measure a stock volatility, we tend to think of something as, well, Hewlett-Packard or some little biotech. We just look at the returns and we measure the volatility. And it kind of struck me that that seems like an odd way to approach the problem. So now I'm starting to look at how volatility relates to things like industry sector, whether a stock's a value stock or a growth stock, even days of the week effects. So that's something that I will be publishing stuff on over the next year or so, but right now it's in the very early days.
Well, we'll stay tuned for that as well. That sounds very interesting. And of course, our listeners can find your previous works, both option trading and volatility trading, up on Amazon, as well as other fine book retailers. When did Volatility Trading come out, Euan?
I think that was 2008.
2008. So it's relatively recent, so listeners may have encountered it, and if not, I encourage you to surf on over to Amazon and pick it up and dive into Euan's work on volatility trading. And surprisingly, there's an interesting component in that book on psychology and the psychology of trading, which I found interesting in a tome that you think would weigh more towards the statistical end of the spectrum.
Well, it's important to realize that a lot of the trading opportunities we see are there because of psychology.
Yes, that's true. I mean, we had a debate on the last show about the origins of investment skew and how much of that thing that we take for granted today of volatility skew is really derived from the psychology of the market and the fact that most market participants are bullish the market and they have a long bias, and that tends to inform the way options perform. So there's a psychology certainly has a very strong impact on what we do here as options traders and volatility traders in general.
And we could talk about the skew for days.
We might have to do that. We might have to bring you on and talk about the skew for days, because Don and I have been chomping at the bit to do an in-depth discussion of skew in all of its many forms and variants, like commodity skew and equity skew and all sorts of other things, and get into some of the root causes and underpinnings and misconceptions that surround that product. So maybe we'll do that. Maybe we'll have to invite you back to do a special skew spectacular. How does that sound?
I'd love that. There's a lot you can say about it.
All right, great. Well, Euan, thank you for coming on the show, and I'm sure Don wants to extend his thanks as well.
Euan, it's great to speak with you. I'm sorry that I didn't have a chance to meet you in person. I know that earlier in the year, our offices met with you in Chicago, and they said that they really enjoyed the time that they spent with you. I guess I would be remiss if I didn't take at least an extra 2 minutes or so to ask you for a quick opinion about the viability of the products that we are now attempting to bring to the marketplace, and having realized volatility contracts as an on-exchange, transparent type of more easily tradable form of existing variance and volatility swaps that almost always settle to realize volatility rather than implied, and just ask for your opinion on whether such a tool would be useful to you, not only at Bluefin and in your trading endeavors, but what you think in general as to how this might complement the VIX products that are out there already, and what your take on that might be.
I love the product. I've been saying or complaining for years that it's very hard to get exchange-listed volatility products. Volatility's got a lot of great aspects to it. It's relatively predictable. It's a relatively good hedge. It's a good thing for people to trade if they could trade it. And trading volatility through options is very messy, expensive, unpredictable, difficult. I think having exchange-listed volatility products is a great thing. And I also think that the more CNBC put the VIX prints across the top of the screen, the more people are going to realize that there is a separate entity out there now called volatility, which they can trade.
Yes, well, I'm glad to hear that, and it's obviously our opinion as well. Rather than say that VIX would be a competitor, we actually have said several times that we're happy for its existence because it has brought volatility to the forefront and made it a household word, and certainly made the investment community much more aware of its importance. And so I think there's surely room in the marketplace for a product that takes a slightly different approach to the expiration and settlement price and the methodology, and we're looking forward to bringing more such products to the market. A recent update: we've been talking with a couple of the major index providers to bring out an equity product. We hope it won't be too much longer before we have some news on that front, and this is something that I know listeners have expressed an interest in for some time now.
That'll be great. I'm sure a lot of our audience will be excited to dive into some of your products when they're. A lot of them are interested in the euro, but that's not their primary trading vehicle these days. They want to dive into something with a little more equity teeth in it. So I'm sure they'll be excited about that. And Euan, thank you for coming on the program. We'll definitely have to bring you on again, maybe for that giant skew spectacular that Don and I are planning down the road.
Thanks very much. I look forward to coming back if you think it's worthwhile.
Great. Thank you.
Thank you, you.
All right, and that's going to do it for our Volatility Viewpoint segment, and now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball segment. This is, of course, the portion of the show where Don speculates wildly, and I have to hold him back and remind him that it is not our place to go so far out into the forefronts of the markets. But we're going to kick things off before we even get to Don and his wild speculation. We're going to kick things off with someone else who is also prone to the occasional bit of wild speculation himself, our volatility pit reporter, good old Mark Sebastian from OptionPit.com.
It's what I do. No, I know that we have more coming up. I feel like we've got one more push next week coming up, and then maybe we ease up. I've been telling people that I expect this to be of a magnitude greater than the flash crash and less than 2008. Somewhere in between, but more toward the flash crash. So, you and I are going to be talking in around Halloween when your little guy is dressed up as Superman and my little guy is wearing the ubiquitous pumpkin costume.
My guy will be a little standard deviation to simplify risk.
So we, I expect one more big push next week, and then we will hopefully relax after that. And that's kind of my plan. I do think that come Halloween, you and I are going to be kind of lamenting the fact that we didn't unload September VIX futures.
Yeah, we're seeing you see the September VIX pricing it in, but there's still in the farther off months, there's still all the quote unquote pros out there are still pricing in the VIX inevitably coming off, like we saw after the flash crash and we saw after extended periods after 2008. So, the question obviously right now is timing, and I think you're crazy if you don't at least have an upside hedge on if you're trading VIX right now, or at least are not getting the hell out of the way of an upside spike and then preparing for it to inevitably, but perhaps much more slowly than you'd like, come off to the downside.
Yeah, it's interesting. It will come off the downside. It's always interesting. I've looked at the statistical data. The VIX does not come off as quickly as it explodes. But it doesn't come off much that slow either. It's really surprising. Some of its moves can be massive in both directions.
Well, we saw some big down days recently, too, in the VIX. So, it has to come off. But I think if you look at the flash crash one, it took about a month to get back to pre-flash crash levels.
It did.
Which, when you consider that was just a one-day aberrant event that's a long time.
Well, and if you consider that the flash crash wasn't the peak in the VIX. Right?
It actually, I think was it a day or two after?
No, it was May 21st. It was a full, there was some fundamentals behind the flash crash. That's the thing that people don't realize. We were already having a crappy day. So it's not that it was just that there was some sort of weird mistake that really sent things order. But even if not for the flash crash, we would have been down $25 to $30 that day. and we'd been down $25 or $30 the day before. So that's something to remember. It's not like this is some sort of. It's not like we weren't supposed to be down. We just weren't supposed to be down that fast.
All right, and thank you for that, Mr. Seabass. And of course, we do cover, as Don alluded to earlier in the show, the broad spectrum of volatility and volatility products, including those ever so enticing Euro vol contracts. So Don, what's on tap? What's coming up? What's in your crosshairs for Euro volatility in the coming week?
Well, we've got actually 2 weeks to go until the expiration of our two simultaneous September products. It's always kind of fun to look at the remaining time and to see how the 1 month may be pricing what's left to the contract in future volatility and how the 3 month is handling that. You'd expect that the two estimates would be rather close, and 12.4, 12.7 or so is sort of the case here. Contracts are trading lower than that at the moment. So the trader's point of view is that before the expiration, we still might have a little bit more volatility to come. Meanwhile, the Volatility Institute, which is Robert Engel's work at VLab over at the NYU Stern School of Business, is actually predicting settlement prices or expiration prices for the two contracts. And if readers take a look on our website, not readers, but listeners, I'm sorry, they'll find 10.82 as the forecasted expiration for the 1 month product and 1168 for the 3 month, which of course has logged more data points. So we'll keep an eye on all of that and report back next week as to what's taken place.
All right, thank you for that, Don. And that is going to do it for our Crystal Ball segment. That's also going to do it for this episode of the Volatility Views show. I want to thank our guest, Euan Sinclair, for coming on the show, and remind our listeners again to check out his books, Volatility Trading and Option Trading, up on Amazon, or just search for his name, Euan Sinclair. That's EUAN Sinclair. So search for him on Amazon if you want to pick up those books, and we'll keep you informed on the latest progress of his research, and if he does indeed publish that paper for all of you to see on first-time exit volatility measurement. And I also want to thank my cohort, my partner in crime, Mr. Don Schlesinger from the Volatility Exchange, for joining me on the show today. And Don, before we go, what is new, what is fun, what is exciting for our listeners up there on the old volex.us website this week?
Well, I don't know that there's anything new that's been added, but there's surely a lot of exciting information. And so always invite our listeners to have a look around, a great deal of data. As a matter of fact, I think we are working on adding some historical data on a few more of the equity indices and a few more products. So have a look around. Lots of good research, lots of good information, and we continue to strive to make it a better product from week to week.
And in the What's New front, our listeners can also keep an eye on iTunes, because, of course, right now you subscribe to the show as part of our Options Insider Radio Network feed. Many of you have asked for a dedicated Volatility Views feed, and that is coming as we speak. We have finalized all of our art and all the other issues that go along with that, and now we've submitted it to iTunes, so it should be active in iTunes, hopefully by the time this show goes live next week, if not a day or two after. You never know. The iTunes approval process is a vague and mysterious beast. Could take a day, could take a week. Who knows? But it should be up there shortly, so you should be able to search directly for Volatility Views in the iTunes store shortly, and that will also help many of our new listeners find the show and check it out and help continue to propel this show up into the stratosphere as it has been in recent episodes. And of course, if you want to get in touch with Don and myself, you can always leave a message or leave a voicemail at 312-544-9356, or you can shoot us an email, questions@theoptionsinsider.com. You can leave us questions on our Facebook pages, either The Options Insider or your Facebook page. Is it Volatility Exchange, Don?
Yes.
Go search for Volatility Exchange in Facebook. You can find us there. Of course, you can contact us via Twitter. We are twitter.com/options, and the Volex guys are, of course, twitter.com/Volex_info. And, of course, the most common way people can get in touch with us is via our forum on theoptionsinsider.com. Just surf on over to the forum page and scroll down to the listener questions for Volatility Views segment and leave your questions, comments, or feedback there. I know we've been kind of full with guests lately, haven't had a chance to get to your listener questions. We'll get to them on an upcoming show, and we'll dive into the mailbag. Maybe we'll do a whole mailbag show just to catch up on some of the questions we have, because I know a lot of you have been sending in interesting questions and comments. But I want to thank all of you for listening and downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts or volatility trading, please visit www.voix.us. If you would like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your questions in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com, via Twitter at twitter.com/options, or facebook.com/the Volatility Exchange, and by voicemail at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VOIX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.